Right. Um, is everyone ready? Can you hear me? Yeah. Right. I don't know what time is your time over there, but now it's morning. So good morning, everyone. Welcome back to this financial derivative. I hope you have been enjoying my class again. I hope it's not too boring about all this financial stuff, but nevertheless, I think it's still some pretty good knowledge that you can retain, right? To be able to help yourself, right, in terms of investment later on in life. Right, it's something like I say won't expire. So it's actually a lifelong skills that you will be learning over here, right? So it's always good to know about financial literacy, right? Right. So today we're going to take a look at the second part of future, chapter 8, right? So that's very chapter 8. Right. Just a quick revision of what we have been talking about. So when you have a long position, when you assume a long position, means you actually buy, right? So when you do a short position, you're actually selling something, right? So again, the differences between the forward contract is forward is done over the counter, future is done on the stock exchange, right? Oh, did I just cough? Hope I'm not getting any covert. Right, future contract is the exchange, right? Forward contract. So they are all private. Forward contracts are usually customized or a private agreement, right? So it's a mutual agreement between two parties, right? The other differences is in a forward contract, the settlement is actually done at the end of the maturity date, right? At the end of the contract. There's always this settlement is always done at the end of the contract. Whereas in the futures, right? Future contracts is actually settled almost daily, right? The daily settlement, and this is done rather than at the end of the contract, right? So that's another differences. So basically, we'll be looking at some of the differences between the future and the forward contract, right? So the other differences that you can observe, right, in the future contract, okay, normally they are the they are the speculators, right, who are always betting on the market directions, right, whether it's going up or whether it's going down. So speculators are the one who always like to play with the futures. They like to play with the futures, right, because of uncertainty, and that's where there's high risk. And since there's high risk, there's more opportunity to earn money, right? So that's where they are coming from. On the other hand, forward contracts are usually more for serious hedger, right? Serious hedgers, manufacturer, producer, or buyer who really want to see that they can eliminate the volatility of the price, the assets price, right? Because they are more keen in getting the delivery of the assets, doing the cash settlement. They are mainly more keen to fix. So there are less of a gambler in a forward contract. There are more serious people who want to uh, take the underlying assets. So nevertheless, here is a simple summary table to tell you about the differences between the forward versus the future contract, right? So very quickly, forward trade over the counter, future exchange, forward non-standards, future standardized, right? And there's a range of delivery dates. This only a fixed delivery date. So you find that future you can bet on September oil price, October oil price, December oil price. So there's quite a range of delivery date you can choose to, right? So settlement is daily, right? Or in terms of the whether profit and loss, settlement is here over here is actually at the end of the day. Delivery cash and this contract is usually sometimes the contract are closed even before maturity, before expiry, right? So future you can see a lot of transactions going on, right? Interchange hand over the exchange. So that's why the exchange can be quite busy. Right, let's take a look at some examples again. So here we have 5,000 barrel price contract for 5,000. So we have a pricing over here where we say it's a $4 per vessel for some grains, I suppose. Yeah, grain, right? And you need 5,000, right? So the manufacturer, whoever need 5,000. So how do you calculate the profit and loss, right? So example, so from $4, let's say it moves up, right? The future contract for this, the market price actually goes up to $5, right? From $4, it went up to $5. So, what is the future contract in store for these two guys, right? So, let's take for example, we have a farmer here, right? The farmer actually produced the grain, right? And you have another buyer bakery who trying to buy from this farmer the grain, right? So you have this scenario, right? A farmer producing the grain, and you have a bread maker, right? Trying to use the buy from the farmer the grain so that it can make to make flour, right? So that it can make bread for sales, right? So these two parties actually come together and they want to maybe fix a price, right? So they can also enter into a forward contract. Now both parties, not necessarily you have to look for somebody else, right? So they actually can go into a betting on the future contract. So in this case, the farmer uh, decided to do a short sell, okay, for $4 per vessel, and we are talking about what? What's the quantity? 5,000, 5,000, right? So the volume of transaction between these two is actually 5,000. So they want to bet on the 5,000, right? So both parties trying to fix the money, the price at $4 per vessel, right? So now you see this last scenario, $4 went up to $5. So what will happen, right? So after let's say 1 month later, the farmer will release the grain, and then the bread maker will pay the money at $5, right? So this is the amount transacted, $5, right? So $5, but you must time 5,000 because this is per vessel, right? So that will give you 25,000 in total value, right? So that is the total value, and then on the other hand, there's a future contract. Okay, so future contract actually state as $4. This is the market price. Market price, right? Here we talk about the market price. So here the future contract is say states that it's stay at $4, and the farmer actually short sell, right? Which means he sell at this $4. But now the market price is actually $5. So what happened? Right? Instead of be able to sell at $5, this future contract, right, actually make him loss. The future contract actually lost $1, right? Even though over here the market price is $5, he made actually 1K, right? But uh, in a way, right? So you have to minus off the $1 here. So $1 actually times 5,000, right? 5,000 is actually 5K. 5K. So in essence, even though the farmer received the $25,000, he lose $5,000. So it back to square one, which is actually 20K, right? 20K will be the net, okay, the net sales by this farmer, right? Because even though the bread maker could have paid the farmer 25K, but he lose the future contract 5K. So net is 20K, and that 20K is actually equivalent to that $4. So in a way, it's like they already hedged, the farmer hedged the selling price at $4. Whereas on the bread maker side, even though she paid, right, in this case paid 25K for the whole transactions, but because of the future gain that she has, right, she also bet on, she buy because the farmer sell at $4, the bread maker actually buy at $4, and then she could sell at $5. So it actually gained 5k, right? So it actually gain 5k over here. So the 5k will minus off this, that give you 20k. So in essence, again, uh, the the farmer, the bread maker actually pay, right? Even though he pay 25k, right, for the sales transactions, but because of the gain from this $1 gain increase, right, times 5,000, you get the 5k. You, the bread maker, actually net off the payment. 25k pay, but then she gained the 5k, so net will be 20k. So everybody are net at 20k, which is equivalent to the hedging price $4, right? So regardless whether the market goes up and down, right? So whoever make the gain or losses, right, in both party will basically have a very stabilized sales agreement over here. So that's how they contra again. Anyway, if you don't really understand, here are all the narrations, write out on what happened, right? So if the contract was settled at $5, right, per vessel, the farmer will tend to lose 5k, right? But the bread maker will make 5k, and that actually square off the whole contract, hash the whole contract. So the actual net is actually the same as the lock-in price that they both party would want to, right? The lock-in price is $4 per vessel, right? So both actually have a net, okay, either payout or receive of 20k, which is $4, right? So you can take a look at this narration. I leave it to you to look through. So here are further. Okay, so what happens if it's the other way? So in other words, the farmer loss in the future contract is offset by the higher selling price in the cash market. So this is what we call hedging. Okay, so this is the second part that you can also look at. Right, let's take a look at the margins, right? We're going back a bit on the margin of how it works. Today we're going to mention another new terms, right? So we talk about this initial margin, means the initial deposit that you have to pay. But then there's also another margin called the maintenance margin. This is normally the minimum level that you need to have, right? So let's say there's this initially you need to put $1,000, but then in order to up for you to do the future trading, but in order for you to continue to do the trading, right, you need to maintain a minimum sum of 500. So that's where the maintenance come in. So let's see how the whole thing span up, right? So for example, let's say you buy something and then you make a loss in the future trading, right? At the end of the settlement trading, right? So you make a loss. Okay, you make a loss. So from 1,000 initial margin, right? It dropped to 400. Okay, so let's say you lose 600 in your future trading. It dropped from 1,000. It dropped to 400. Right? So that is what happened. It's lower than your maintenance margin, right? So this is your initial deposit, 1,000 over here. But let's say you make a loss, okay, for that day, right? And it dropped below your minimum maintenance margin, right? Minimum, right? So if you drop, let's say 400, you left 400. So what will happen? You can't trade anymore, right? The exchange will stop you from doing any more trading, right? So you have to, in order for you to continue doing your trading, right? You have to bring back to the initial margin, right? Which means that you have to go and top up $600 back to the initial margin. Okay, anything here you no need to top up, but the moment you cross the 500 minimum margin, you have to top it up all the way to the initial deposit. Understand? Right? So there's this minimum criteria. So minimum, you drop below, you have to, as long as you're above, then you're not required to top it up. But once you drop below the minimum, you have to reset to the max. So you can see that in the future market, it's actually more of a leveraging game, right? Where you actually use a small value of capital and then you can bet on large commodity, large price commodities, right? So that's leveraging, right? Using small amount of cash and you can bet on high value contract. So let's take a look at what do you mean by leveraging again, right? So it's just like you use 10 cents to buy $100 kind of a headphone set, okay? So and you bet on that pricing. So anyway, let's maybe a better example will be this, right? So let's take a look at this the price of the future contract, right? So every time the price of the future move up, right, the profit gain can be as large in comparison to the initial margin, right? So example, right? So the initial margin is actually $10,000, right? $10,000, right? So you basically you use $10,000 to bet on the indices, right? So what's the value of the indices? Let's say the indices is 1,300, and every index is about every indices is about 250. So the value of the whole contract is actually worth $325,000, right? So every point, every tick is actually 250. So which means that actually what you are using $10,000 to play with a value contract of 325, right? That's how many hundred? Almost 300 times, right? No, sorry, almost about 30 times, right? So 10,000 and you are playing with so much money. Value contract. Basically, you're playing that value. So here is a term, right, that you might want to take note is the tick, right? Tick is basically the minimum increment that can move, right? Every counters they have different increments. Some can move by 1 cent, some move by quarter cent, some minimum 50 cent, right? So for example, let's say there's a counter is trading at $12, right? So the next tick is actually 50 cents. So every increment is 50 cents, right? So you have to buy $12.50 or $11.50. Right? There's no trading at what $12.10, $12.20, right? So it's every increment, right? For the trading price, it's actually 50 cents, right? So different counter have different tick, right? Different increment. So the increments is different, not just like sometimes increase by 10 cents, 1 cent, etc. So that's the minimum price movement. So you'll find that future fundamentals is actually quite similar to forward. By looking at the payoff graph, if you can recall the long forward payoff graph, right? The long forward payoff graph looks something like this, right? A slope, okay, a positive gradient slope, right? That's a slope here, right? Long forward, if you recall, it also looks like this, right? And this is a payoff chart, payoff chart. So in the long forward, right, you can see that it's profitable when the market price actually goes up. Okay, so that's why you say you will always long something when you think that the market price is going up. So because why? From this graph you can say that's where it's positive, right? Positive when there's profit, right? You wouldn't want to have a time where the market price is going down, right? That's where you enter into a negative, right? This is the no zone, negative, not below the future price. So on the other hand, whoever do the shorts, okay, this is the short, right? They would want to and hope that the payoff, the market, okay, will go down. You can look at this. They only get payoff when the market price is decreasing, right? This is the commodity price. When the market price is dropping, the market sentiment is dropping, right? That's where they have profits. So when you short something, when you think that the price is going down, Okay, so that's why you see all this payoff graph. So the future and the forward, the payout is chart is the same. Right, here we have this going long, which is again long is to buy, and then now we use the margin, right? So now we have an initial margin of 2,000, right? And Joe speculate to buy a September contract, right? So like I say, the future have different contract, right? They have September, October, December, up to you. It's all in the listed in the future exchange where you can say which one, right? Then you bet on certain month of the gold price, right? Like in this case, this is a gold price in September, right? That you're betting in the future. Now, let's say we are April. Now we're betting September. I think the gold price is want to be about 350 per ounce. Okay, 350 per ounce. And how many golds you want to buy, right? So let's say you want to look at 1,000 ounce, right? So which is what 1,000 times 350, 350. So the whole value contract is actually worth $350,000. Okay, but how much you're using it to play the game? You only use $2,000, right? To play a value worth of contract 350. That is where we call leveraging. What you use only this small amount of money, and actually you're playing big money, huh? But the thing is, when this drop, it might drop a lot more in comparison to your margin. Let's take a look, right? Let's say the gold price went up by just $2 from 350. It goes up by $2, merely $2. Okay, just $2. So what's the differences in the contract? Merely $2 in the price, and if you are talking about 1,000 ounce, well, here you are talking about 2,000 over, right? This is 2,000. That's a lot of money over here, right? So you can see there's a lot of money even over here. So the profits is 2,000. So what happened? Your initial margin 2,000, and then here is 2,000. So you're talking about 100% leveraging, right? 100% profits over here. Right, so that's where you can see you use $2,000, then you actually make 100% profit. So that's $4,000. That's a lot. But if the price goes the other way, then you might lose the 2,000 100% losses. So that's quite bad. So this is leveraging. So that's why when you do leveraging, you have to be careful, right? And if the margin fall below the maintenance level, you got to top it up again. The speculator go shorts. Okay, so now you're going short the market. You're doing some decline, so you will go into a short when the price level is going down, right? So when you anticipate the price going down. So this is a going short. Initial margin deposit is $3,000. So this is another example, right? Initial example, $3,000. So so dropping 25 barrels. The total value is 25,000, right? So how do you get 25,000, right? So it's basically 25 times 1,000, right? We are looking at somebody want to have 1,000 barrel of oil, so you buy that amount. So that will be the total value of contract, and you're using just merely 3,000 to play this game, right? So what happens if the price go down from 25 goes down to 20? Right? What will happen? You right? So this is talking about short sell. You do a short at 25, like sell at 25, you buy back at $20, right? So that's a difference of $5, right? So what happened? You get a 5,000 profits over here. So the spread. So there's a spread is basically the differences. Hello? Hello? Sorry.
I pressed the door unlock, but
No, cannot resume.
the computer didn't come in. Oh, because
Sorry.
I don't know which button to press, so I pressed the door unlock, so I didn't answer. Let them come in. Let them come in. Oh, okay.
Right. Sorry. So that's the spread. So let's take a look at the spread. What's the difference of spread? The spread is just the differences, right? So you have a calendar spread. So let's take a look at the spread. So this calendar spread is basically try to make the differences of using delivery dates, delivery times. Example, calendar means the period, right? So, for example, I buy some surgical mask, right? I buy some surgical mask today, right? And I wait for the demand. I wait for the demand to go up. So I bought today, then maybe I decided to release and start selling my surgical mask only in October when the demand can surge, when there's greater demand. So that's making what buy and sell using a different time. So you're basically making use of the calendar, the day time difference. Another spread that you can talk about is actually the intermarket spread, right? This is where you basically make use of the differences in two markets, right? So you can buy from one market and then you sell from another market. Another example that you can think of is basically like, money exchange, right? When you do money exchanges, next time you travel overseas or go for tourists, sometimes you can want to change money. So there's many exchanges, right? Money exchanges in different locations. Let's take a look. If you are able to do this kind of intermarket change where you try to buy and sell in different market, making use of the differences in the pricing, right? This is how you could do it. For example, money exchange. Let's say I have this money exchange in, let's say, in Raffles Place, right, or Dhoby Ghaut in city area. They are looking at $1 changing ringgit is $1 to $3 ringgit, right? So let's say I have $10,000, right, Sing dollars that I want to change. So if you use this exchange rate, what you get is you get for 10,000 Sing dollar, you you get a $30 ringgit, right? You take a $30 ringgit. So once you make the change in the money, let's say in Dhoby Ghaut or Raffles Place, then you discover that when you go back to Boon Lay or Ang Mo Kio, another exchange, then you find that the exchange rate are listed differently, and that is to your advantage, to your favor, right? So if you know how to make use of these differences in spread, right, like in this next exchange, money exchanger in, let's say, in Boon Lay, right, are they getting a better rate for ringgit to Sing? So like $1 to $2.95, right? So you find that, wow, just now I changed 30K, right, ringgit. So I immediately, right, on the same day, same day, at different market exchange rate, I can actually convert back to Sing dollars, right? So you notice what's the difference over here, right? With your own initial 10K, now by playing with the different market, different exchange, I on the same day can actually earn $169, right? It could be in a difference of 1 or 2 hours, right? By traveling from Raffles Place to Boon Lay, right? And found a more favorable exchange, right? Market exchanger, I can change, and that will be the money, right? You can basically profit from that. This is where we talk about profiting from the spread, right? By playing at different markets. Right, so that kind of wrap up the whole uh, chapters on future, right? So, well, sorry about some of this commotion, doing something over here.